Good morning. Welcome back to the War Room. I am Malik. Today is Friday, March 27th. This is our first broadcast of the week. We deliberately stayed off the mic since the cages opened on Tuesday because we needed to let the tape play out. And exactly as the underlying mechanics dictated, the market makers just executed the most brutal, calculated bull trap of the entire year. After the 4-day macroeconomic lockdown, the algorithms aggressively hunted for retail liquidity. By Wednesday afternoon, they had artificially pumped the KSE-100 index all the way up to 15,813. Retail traders looked up at green screens, assumed the market was miraculously immune to the 55 rupee fuel hike and the $112 global oil shock, and they rushed in. They walked directly into the slaughterhouse. Yesterday, the smart money dropped the hammer. They unloaded their heavyweights directly into that retail FOMO, violently crashing the index by a catastrophic 5,405 points. The market bled out, closing the day deep in the red at 152,908. Today, we dissect the anatomy of the 158K rug pull, and I will show you why the absolute apex predator of the corporate board is holding an emergency meeting this afternoon. Let us analyze the pure tape mechanics of Thursday's 5,400-point collapse. Look directly at the volume. Over 521 million shares were forcefully dumped onto the main board. This was not a panicked flash crash. This was systematic, algorithmic distribution. The macroeconomic chokehold has not changed. The surging Brent crude barrel is still actively vaporizing industrial profit margins across the board. The institutions knew this. They deliberately pushed the index up to 158,000 on Wednesday to create a fake breakout. They needed retail traders to feel secure so they could use them as exit liquidity. The 158K level was a pure distribution zone. If you bought into that midweek rally, you are now holding depreciating high-risk assets while the foreign funds and local institutions have successfully escaped with your cash. The technical charts are broken. We are back in a macro liquidation cycle. Now we look at today's session. It is Friday, March 27th. The weekend is approaching, the Gulf is still heavily militarized, and the institutions absolutely refuse to hold equity positions over a 48-hour blind spot. Friday phobia is in full effect. But the real danger today lies on the corporate calendar. At exactly 2:30 p.m. this afternoon in Karachi, Engro Holdings Limited is stepping into the boardroom to consider matters other than financials. Let me be unequivocally clear. Engro is the massive beating heart of the PSX. Their subsidiaries span fertilizers, power generation, chemicals, and polymers. They are the ultimate proxy for the entire Pakistani economy. When a conglomerate of this magnitude calls a mystery, non-financial meeting in the middle of a historic market crash, it signals severe operational or debt restructuring to survive the fuel shock. Watch the tape at 2:30 p.m. If Engro signals distress, its gravity will drag the entire index down with it. Here is your battle plan for Friday. 1. Respect the Friday phobia. Do not buy the morning dips. The institutions are looking to secure cash for the weekend. Any upward momentum in the morning session will be aggressively sold into by the afternoon. 2. The Engro gravity. Keep your hands off the keyboard around 2:30 p.m. The Engro mystery meeting is a psychological black hole. It will create extreme algorithmic whiplash across multiple sectors. 3. Maximum cash supremacy. You survived the 5,400-point trapdoor because you respect the macro data. Do not get greedy today. Let the week close. Let the algorithms bleed each other out. Protect your capital. Command the Friday.